Hi, I'm Bill Walker. Going against the grain is never an easy path to take when it comes to investing, but Clayton Zacharias has followed a contrarian approach that has really paid off. He's here with me today to talk about how this approach can turn volatility into opportunity. Clayton, good to see you. You've posted some really great industry-leading results over the last 4 very volatile years as lead manager of the Trimark Canadian Endeavour Fund. Can you share with us how you've achieved those results?
Well, Bill, I think it was really a function of 2 things. It's first and foremost the Trimark investment approach itself, but also secondly, and equally important, is really our unwavering adherence to that approach during that very difficult and volatile period in the markets. Now, I know everyone probably claims that, but I think in this case, the proof really is in the pudding. And so when we think about how we approach running this fund, we're really focused on not only outperforming the market over the long term, but also generating a strong positive absolute return. And for us to achieve that, we think we need to take a more contrarian approach to the market where we're thinking independently to form unique ideas that are different than the consensus view, where the herd is going. And really having a high level of conviction that when we identify those select opportunities based on our rigorous analysis, having the conviction and mental fortitude to take action on those ideas and really stick with them regardless of what's going on in the market.
You mentioned a select few. Your fund is highly concentrated, 20 to 25 names in the portfolio. So I'm wondering, I guess as others are, how can you be diversified with only 20 to 25 companies?
We are much more concentrated than the average Canadian equity fund, and we do appreciate the importance of having a diversified fund. So we spend a lot of time thinking about the underlying business drivers and risk exposures for the companies that we own in the fund, making sure that there's not too much overlap and correlation across our ideas to ensure that appropriate level of diversification is achieved.
Now, I know you have a mandate to buy any sized company within the Trimark Canadian Endeavour Fund, but you seem to have a mid-cap bias. Why is that?
We just tend to find more opportunities in that mid-cap space, and there's really 2 reasons for that. If we think about the type of opportunities that we really get attracted to, it's quality businesses that can meaningfully grow over time, and secondly, the need to buy those at a discount to intrinsic value. We need some sort of inefficiency in the market to give us that opportunity. And when we think about the difference between big cap companies and smaller to mid-cap companies, there's just more market inefficiency as fewer analysts and investors follow those smaller to mid-cap sized businesses. That's really what creates the opportunity for us on the valuation side. And because of the law of large numbers, there's just more opportunities for companies to grow as you get down the market cap scale.
So can you give us an example of one of these mid-cap companies?
Sure. So one of the companies that we bought last fall as the market was reacting over the fear of the issues going on in Europe and in the United States is a U.S. specialty chemical manufacturer called Solutia. This is a business that had very dominant positions in niche markets globally in the specialty chemical area. And this was a company that was generally misunderstood by the market, where the market didn't seem to appreciate the long-term potential around the level of profitability of this business. That really gave us the opportunity in the fall of 2011 to buy this company at a very cheap valuation, less than 10 times earnings and free cash flow. Now, it's interesting when you buy these companies and if the market doesn't recognize the value, there are times that someone else will, and in this case, a large strategic buyer ended up taking out the company for a very significant premium to what we paid for it.
Now, I wanted to ask, with all the volatility investors experienced in 2008, how are you managing cash within the fund differently?
Certainly living through the financial crisis over the last 4 years, one of the important lessons that we took away from that experience was the value of cash in the fund at certain points in the market cycle. So I want to be clear that we haven't changed our investment approach. Cash in the fund continues to be a residual of our bottom-up process, but we are more willing to hold cash in the fund at times. And what we mean by that in terms of a residual of our bottom-up process is that we're very disciplined around valuation, and so when we're in a market period where valuations become stretched, we'll be inclined to trim the positions that we already own in the fund, and if we find it difficult to find new compelling opportunities in the market, we'll let the cash be the default as we start trimming positions. And the idea there is, if we're in a frothy market environment, when we see a market correction at some point, the cash in the fund will act as a shock absorber on the way down and give us that flexibility to aggressively go after ideas when valuations are more compelling.
So how would you say your fund is different versus the TSX or other Canadian equity funds?
I think in addition to having a somewhat unique contrarian approach in general, I think if you look at how the portfolio is constructed, we've already mentioned the level of concentration, which is very different than most Canadian funds. But really, if you look at it, we completely ignore the benchmark. So we have no interest in what the overall market looks like. We're looking for 25 very unique and high quality ideas at any point in time. And so the end result is a fund that looks very different, and we don't have exposure to all parts of the market. And if you think about Canada specifically and the TSX, really two big dominant themes that are represented heavily in the market. It's resources and financials. And if you look at our fund, we just have much different exposure levels to those two areas. And we think, we actually have a more broadly diversified level of industry exposure versus those two big dominant themes in Canada.
Now, you were rewarded for your success with the Trimark Canadian Endeavour Fund with the role of lead manager responsibilities for Trimark Income Growth Fund. Can you explain to us or give us an overview of any changes that you've made to that fund?
Sure. So we took over that fund at the end of April. So it's been about 5 weeks now, and we've been transitioning that fund to make it our own, have mental ownership over the companies in that fund. I'd say at a very high level, investors should expect us to approach running that fund as we have with the Canadian Endeavour in terms of the investment approach overall. But there are some key differences given the differences of the mandate. One important consideration is the size of the fund relative to the Canadian Endeavour. The Income Growth is a much larger fund at $3 billion of AUM versus the Canadian Endeavour at $650 million. It means that on average we'll end up owning larger companies in the Income Growth. We'll also own more companies on average. So instead of 25 in the Canadian Endeavour, we'll own 25 to 35 businesses in the Income Growth. The other difference is the foreign content, which is capped at 30% in the Income Growth versus 49% in the Canadian Endeavour.
So just to sum up, given those characteristics, why should investors consider buying into those funds?
I think it goes back to the first question in that over a very challenging period in the market over the last 4 years, we have demonstrated our ability to apply the proven, time-tested Trimark investment approach with unwavering commitment, and I think the results demonstrate that ability. And I think in this type of environment where there is a lot of uncertainty in the markets, the way our funds are positioned with a level of cash, with exposures that look very different than the overall TSX market and a lot of competitor funds, I think these funds really provide a nice complementary offering to the typical Canadian equity portfolio to give some diversification away from those two big dominant themes in Canada.
Well, Clayton, congratulations on your successes, and thank you for your perspectives today.
Thanks, Bill.